Okay, we're recording.
He's too cool for school.
Of course. Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And we're here with you this afternoon for our weekly wrap-up. Graham, it's been another week, so fill us in on what's been going on.
Well, I feel like we're a broken record, right? Every week we keep saying that the drama is still in the market, the roller coaster. Heck, we're still on that ride. And I don't think last week was any different. We've had 7 straight weekly losses for U.S. equities. So we've been in a prolonged pullback here. Are we setting ourselves up for maybe a bounce? I think that's in the short term, probably pretty likely, but is it going to hold? And in terms of, will that bounce hold so we can build off of it? I don't know. I think that still might be a little too early to make that call yet. I still think there are things that need to be worked through the system. So the fear of recession, the fear of stagflation, all these terms are coming up and being discussed, about the markets. We saw the NASDAQ composite off about 4%, S&P off about 3%, but we actually saw the Russell, the small cap, kind of one of the most volatile sides of the market, only down 1%. I know that sounds like it's kind of a consolation prize, but that's less than the others by a pretty decent amount in comparison. 8 of the 11 S&P 500 sectors were down, so we had a pretty broad-based sell-off. We really had a pretty big sell-off, about 8% we saw on consumer staple side of the market, usually a side of the market that holds up pretty good. And I think the fear was with the consumer. Is the consumer finally cracking under the pressure of the high inflation and how the consumer is getting hit on all sides? So we really saw, really a big pullback in the side of the market that you usually don't get necessarily in this type of an environment. We saw yields edge down, let's say on the 10-year, the 20, so on and so forth, on the government bonds. Those tend to be safe havens where people, if they're fearful of risk, they're fearful of equity exposure, they tend to run to that side of the market. So we had it really pull off or pull away from that 3% on the 10-year down I think it was around 2.8 to close out the week. So I think that was pretty interesting, even though we're in the middle of an interest rate tightening cycle for the Fed. And the Fed has made it very clear they're going to do what they need to do as long as they need to do it to get inflation down. So again, I think the last week was really about consumer staples, 2 major companies, Target and Walmart. For middle America, earnings were not great. Seeing some pressure from inflation, supply chain, so on and so forth. And those stocks were down 25 and 30%. So I think that was a real pressure on the market on why we really sold off last week pretty hard midweek. And then we kind of rallied back a bit on Friday.
Okay, well, we've got Memorial Day weekend coming up, which is kind of the kickoff to summer. Do you see any reprieve coming our way as we approach summer?
I guess, how do we define reprieve, right? I mean, going straight down for 7 straight weeks, I don't know if I see that, but I wouldn't be surprised that we have a little more pain before maybe we level out, maybe start to base and hopefully can rally off that. These things take time, right? It's not a sprint. This is a marathon. As we said to our clients all along, our viewers, listen, this is not the time to take unnecessary risk, but through a good diversified portfolio of stocks and bonds and different sectors, growth and value, just focus on high quality companies that have earnings, hopefully pay dividends, maybe do share buybacks. If you focus on that area, you should ride through this quite well. But if you need money today for a project, and I know we've said this over and over, or if you're retired, or you just need income from your accounts, we really want you to be conservative. We want you for at least that portion of those needs, for 6 months to 1 year, let's set that in cash. Let's be extra conservative, just in case things get worse. So you don't have to be pulling from bonds and stocks as they're going down, right? We don't want to get into what's called negative sequence of returns.
That makes sense. Okay.
Right.
Thank you so much for keeping us updated. And let me just update our viewers about one thing we have going on this week, which is our monthly Lunch and Learn. Every month, the last Wednesday of the month, we host our Lunch and Learn webinar. And this month is not to be missed. I'm sure we're going to be talking about some of these things we touched on today in more depth. So please make plans to join us at noon. Thanks so much for joining us today, and we will see you again next week. And it'll be Tuesday, since we will be out of the office on Monday for Memorial Day.
Right.
Thank you, everyone. Have a great weekend. And
Take care.
Bye-bye.